Welcome to Alpha Recap, your end-of-day wrap on the market action. We're coming at you after the close with a lot to unpack. Geopolitics, oil, corporate legal news, and wild small-cap swings. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. The tape today was complicated, layered, really. Markets closed mixed, and you could almost pick whichever narrative you wanted depending on the sector you follow.
Yeah, geopolitics was front and center. The big headline was Iran tightening rules on transit through the Strait of Hormuz. And that's not abstract. That waterway handles a huge chunk of seaborne crude.
Exactly. And just to put a number on it, and this is the key data point, the Strait moves somewhere between 17 to 21 million barrels per day, which is roughly 20% of globally traded petroleum. That's a real transmission channel to oil markets.
So, what really stands out here is how that kind of move translates into three things: physical rerouting, insurance premia, and a psychological premium, where traders start widening price bands.
Right. And the other thing is even modest increases in freight and insurance can lift landed costs materially. That's why you saw energy names and physical market participants reacting today.
We did see gains in energy and safe haven flows. And then, in a totally different corner, you had these explosive moves in small caps that looked like pure flow and momentum rather than fundamental re-ratings.
BIF nearly doubled on about 238 million shares. AIFF was up about 58% on 72 million shares. SVCO shot up roughly 52% on nearly 12 million shares. RNWWW was up about 71%. And on the downside, TOIIW plunged about 52%. Wild day.
Not a great day for that one. Honestly, I was a bit surprised by this one.
Those microcap moves highlight a fractured market narrative. You could have speculative retail flows driving one name while energy fundamentals move another, and safe haven buyers rotate into fixed income or gold elsewhere.
I mean, when you step back and look at this, it's almost like three markets in one. Geopolitical-driven commodity markets, corporate-specific stories, and pure momentum microcaps.
Which brings us to the corporate side. Stellantis scored a legal win. A shareholder suit alleging channel stuffing was dismissed. That was a de-risking event for the stock.
Right. That removes a headline overhang and pushes the story back to operations and product cycles instead of litigation. For investors, that's meaningful.
And Green Rain Energy opened a review of legacy convertible notes and tightened shareholder protections. That's the sort of governance action that can materially change dilution risk for current holders.
The convertible note review is a good example of why micro-corporate events matter more to owners than day-to-day macro noise. If the conversion mechanics change, that can reset the equity math.
Also worth calling out United Bank shares. The stock ended the day at $39.29 after modest outperformance. Over 6 months, it was up about 5.8% versus the S&P, up about 2.3%. But investors are waiting for more earnings detail.
Small beat, but not a blockbuster. With rising geopolitical risk and potential fiscal strain, banks could see net interest margins and credit spreads move. So that's something to monitor.
Let's step back and address a big debate playing out among analysts: the magnitude and duration of the Iran shock.
Some are warning this could morph into something like a 21st century quagmire, invoking the Vietnam analogy: prolonged asymmetric tactics, proxy networks, long-term fiscal and human costs.
Others are more sanguine, assuming any escalation will be limited and markets will absorb it quickly. That's really a tail risk versus base case debate.
If you buy the tail risk case, you're thinking higher commodity volatility, higher insurance costs, and ultimately more fiscal spending that pushes real yields up. That's bad for long-duration growth names, the so-called Magnificent Seven, because higher real yields compress valuation multiples.
Yeah, that tracks. And if you're a macro trader or a CTA, expect elevated volatility across energy and FX desks. Tactical long exposure to Brent or short-term options makes sense for some, but watch the gamma risk on short-dated structures.
For the energy investor, the Hormuz measures increased the case for near-term long exposure to physical crude or producer equities. But as always, pocket-level details matter. Refinery utilization, existing inventories, and counterparty flows can blunt or amplify price moves.
Right, and on the ownership moves front, there was also a sale by Control Empresarial de Capitales of about $27.9 million of PBF Energy. Some read that as a negative, others see it as liquidity management.
So it's a mixed signal. If oil prices rally from a Hormuz-driven squeeze, that selling might not matter. But if it's a sign of deeper concerns, refiners or midstream names could get hit.
A few quick reaction bites.
Big moves in the microcaps.
Watch out for mean reversion.
Yep, and retail traders, the advice is repeatable. Manage position size tightly, use limit orders, and be ready for quick reversals on thinly traded names.
Which gets us into market microstructure. Those double-digit and triple-digit moves in microcaps show how withdrawal of market making, concentrated position risk, and headline mania can cause huge slippage. You can win big or lose fast.
Right, and for longer-term allocators, the lens is different. You care about marginal changes in inflation and the fiscal path. A protracted conflict could mean bigger treasury issuance and higher real yields, which pressures long-duration growth.
Fixed income holders should consider short-duration bonds or T-bill ladders if they expect yield upward pressure. Inflation-linked exposure might also make sense if supply-driven CPI impulses materialize.
Let's talk policy headlines. There was an odd political note in the briefs suggesting that cannabis rescheduling or even high-profile disclosures could be used to shift headlines. If cannabis is rescheduled out of Schedule 1, that would loosen banking, tax, and research constraints for that sector.
Some desks treat that as a plausible economic catalyst with real banking implications. Others think it's more political theater with limited, lasting market impact. I'm in the cautious camp. It would be material if it happened, but don't count on it until it's official.
I mean, when you step back and look at this, the policy noise is the kind of thing that can create short-term repricing in niche sectors, but macro and corporate fundamentals still drive big-picture allocations.
Let's hit a practical watch list. First, monitor enforcement in the Strait of Hormuz and shipping insurance rates. A widening war risk premium, or forced rerouting, will be an early signal to favor energy longs.
Second, watch Treasury issuance plans and any emergency funding bills. Rising fiscal supply matters for rates and long-duration equities.
Third, for corporate micro events, keep an eye on Green Rain's next disclosures and how Stellantis leverages this legal win operationally.
Fourth, momentum traders need a clear unwind plan for names that spiked. BIAF, AIFF, SVCO. Because heavy volume rallies can continue, but mean reversion is common without fundamentals.
And fifth, consider option-driven hedges rather than outright exits for portfolios sensitive to geopolitical spikes. Long-dated puts on indices, short-term call spreads for tactical energy exposure, or collars to keep upside while buying protection are all sensible tools.
So, what really stands out here is discipline. Position sizing, hedge construction, and knowing your time horizon matter more in days like today.
Yeah, absolutely. For short-term traders, tighten risk controls. For longer-term allocators, weigh marginal inflation and fiscal shifts against valuation. And for everybody, be explicit about exposure to commodity tail risk.
Quick recap. The headlines knit together into 4 themes. Geopolitics as the primary macro risk, possible policy distractions like cannabis rescheduling, corporate idiosyncratic repricings, and momentum-driven microcap volatility.
Bottom line, credible geopolitical risk has lifted commodity tail risk. Corporate governance and legal developments remain very stock-specific, and the microcap mania makes cash management and execution discipline essential.
Final takeaways. 1. Watch enforcement in the Strait of Hormuz and shipping insurance. 2. Monitor Treasury issuance and any emergency fiscal moves. 3. Treat convertible note reviews and litigation outcomes as material for equity holders. And 4. Be cautious with momentum trades. Have exit plans.
Yeah, that tracks. And a reminder, if you're thinking about hedges, think about options and structured collars instead of blunt exits, especially if you want to keep upside.
All right, that's our recap for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for joining us. We'll be back after the next close with more analysis. Stay safe out there and keep an eye on those shipping lanes.